What is money really? Think about it. It's not just the paper in your wallet or the numbers on your screen. We treat money like it's a given, a fundamental force of nature. But is it? Or is it just a shared delusion, a collective agreement that we've all bought into? Understanding money is not just for economists in tweed jackets. It's about understanding the forces that shape our lives, from the price of milk to the stability of our entire financial system. Because when it comes down to it, money isn't just about wealth, it's about power. And right now, most of us are handing that power away without even realizing it. Ignoring it won't make it go away. We're talking about your life, your future, your ability to afford that vacation where you don't spend the entire time frantically checking your bank balance. By the end of it, you'll never look at a dollar the same way again. Remember that time you went to the store and that thing you always buy, like, let's say a block of cheese, suddenly costs twice as much? That's inflation, baby. Inflation essentially means that the purchasing power of your money is shrinking like a cashmere sweater in a hot dryer. That dollar you have today buys less tomorrow. It's a slow, insidious process, like a frog being boiled alive in a pot of gradually heating water. Except in this case, we're all the frog. Imagine you're blowing up a balloon. The balloon represents the economy, and the air you blow into it is like the money supply. The more air you pump in, the bigger the balloon gets, right? But here's the catch. As the balloon expands, the rubber gets thinner. As more money floods the system, the value of each individual unit of currency decreases. Your hard-earned cash doesn't go as far as it used to. Let's talk about debt, shall we? That uncomfortable topic that we all like to pretend doesn't exist, like that weird smell coming from your roommate's room. But here's the thing, debt is a huge part of our current economic system. It's so pervasive, so deeply ingrained that it's practically become the wallpaper of modern life. We're constantly bombarded with messages telling us to spend, buy now, pay later, 0% financing. It's almost as if the entire system is designed to keep us trapped in a never-ending cycle of borrowing and owing. And the thing is, not all debt is created equal. There's good debt, like taking out a loan to invest in your education or start a business. And then there's bad debt, the kind that saddles you with high interest rates and cripples your financial future faster than you can say credit card statement. Even if you're super responsible and avoid debt like it's the plague, you're still affected by it, because the truth is our entire economy is built on a foundation of debt. Remember the 2008 financial crisis? Of course you do. It was the economic equivalent of a dumpster fire in a hurricane. And at the heart of that dumpster fire was something called the subprime mortgage crisis. Now, I know what you're thinking. Mortgages? That sounds about as exciting as watching paint dry. But trust me, this stuff is important. Because the subprime mortgage crisis is a perfect example of what can happen when the financial system goes haywire. Banks started giving out mortgages to people who couldn't actually afford them. These were the subprime borrowers, folks with low credit scores and shaky financial histories, so these banks bundled these risky mortgages together and sold them off to investors as mortgage-backed securities. They were basically selling ticking time bombs disguised as investment opportunities. But then, predictably, the housing bubble burst. Home prices plummeted, and suddenly, all those subprime borrowers were underwater on their mortgages. Section 5. Capitalism Unveiled. A historical perspective. Let's rewind the clock a bit, shall we? Back to a time before credit cards, online banking, and those annoying commercials where everyone's inexplicably happy about getting car insurance. To understand the wacky world of modern finance, we need to take a trip down history lane and explore the origins of capitalism itself. Now, capitalism as a system has been around for centuries. At its core, capitalism is all about private ownership and the pursuit of profit. It's a system where individuals and companies compete for resources, customers, and of course that sweet, sweet cash. The seeds of capitalism were sown during the Renaissance, a time of great intellectual and artistic flourishing. As trade routes expanded and new markets emerged, a new class of merchants and entrepreneurs began to accumulate wealth. These early capitalists challenged the traditional feudal order where power was concentrated in the hands of landowners and the church, but it wasn't until the Industrial Revolution that capitalism really took off. Section 6, the alchemy of finance, how banks create money. Now, buckle up because this is where things get really wild. We're about to delve into the magical realm of money creation, where banks, with a little help from something called fractional reserve banking, essentially conjure money out of thin air. You see, most people think that money is created by the government, right? They picture some shadowy figures in a secret underground vault printing stacks of cash like they're playing a game of Monopoly. But the truth is far stranger, and dare I say, more entertaining. Fractional reserve banking is the system by which banks can lend out more money than they actually have in reserves. Let me repeat that. They lend out money they don't even have. Banks are required to hold a certain percentage of their deposits in reserve, known as the reserve requirement. Let's say that requirement is 10%. That means that for every $100 deposited, the bank has to keep $10 on hand and can lend out the remaining $90. Section 7. Goldsmiths and the birth of fractional reserve banking. To really grasp the absurdity of fractional reserve banking, we need to hop in our time machine and journey back to the good old days when goldsmiths were the OG bankers. Picture this, 17th century London, bustling with merchants, traders, and the occasional plague outbreak. People needed a safe place to store their gold, and who better to trust than the burly blokes who made jewellery? So goldsmiths became custodians of people's wealth, issuing receipts for the gold deposited with them. These receipts essentially were early forms of paper money, representing a claim on the actual gold held in the goldsmith's vault. But here's where things take a turn. Goldsmiths, being savvy businessmen, realized that they had a golden opportunity, pun intended. They noticed that people rarely withdrew all their gold at once. Most were content to use their receipts as a medium of exchange, trading them for goods and services. The goldsmiths figured, hey, if people are just using the receipts, why don't we lend out some of this gold that's just sitting here gathering dust? And thus, fractional reserve banking was born. They started issuing more receipts than they had gold in their vaults, loaning out the excess and charging interest on those loans. Section 8. The peril of bank runs. But, and this is a big but, fractional reserve banking operates on a foundation of trust. It's like that friend who's always borrowing money and promising to pay you back soon. You believe them to an extent, but there's always that nagging doubt in the back of your mind. The problem is, if everyone starts doubting at the same time, things can unravel faster than a cheap sweater in a thorn bush. That's where bank runs come in. Imagine this. A rumor spreads that a bank is in trouble, that it might not have enough reserves to cover its deposits. Panic ensues. Depositors, fearing that they might lose their hard-earned savings, rush to the bank to withdraw their money. The problem is the bank doesn't have enough cash on hand to satisfy everyone's demands at once. Section 9. Financial literacy, your key to economic empowerment. So here we are, folks. At the end of our whirlwind tour through the wacky world of money and capitalism, we've explored the illusions of currency, the insidious nature of inflation, the dangers of unchecked debt, and the mind-boggling concept of fractional reserve banking. It's enough to make you want to bury your head in the sand and pretend it's all just a bad dream. But here's the thing. Burying our heads in the sand won't solve anything. Ignorance is not bliss, especially when it comes to our finances. The only way to navigate this complex and often confusing landscape is to arm ourselves with knowledge. We need to become financially literate. Financial literacy isn't just about understanding compound interest or balancing your checkbook, although those are good things to know too, son. It's about understanding the forces that shape our economic reality, from the policies of central banks to the inner workings of the financial system. It's about asking questions, challenging assumptions, and demanding transparency. Because here's the truth, the system is rigged. But we can change that. We can educate ourselves and our communities.